There's something hiding in plain sight on every chart you've looked at. Something that once you see it, you can't unsee it. Every pattern that you see on the 1 minute happens on the 15 minute. Every pattern that you see on the weekly happens on the 4 hour. The same institutional footprints, the same psychology, it plays out through every time frame in the market. Markets are fractal structures. Most traders have no idea what this means or how to actually use it. But once you understand how these patterns repeat on multiple time frames, you're never going to look at the charts the same way again. I'm about to show you something that's going to completely change how you view the market and how you can use this to never be confused about market direction again. Now, what actually is a fractal? So the definition of a fractal is it's a complex, never-ending geometric pattern that exhibits self-similarity across different scales. Now, that's like the scientific mathematical definition, but the way I'm going to explain it here is a lot more simple. If I was to draw a square, now I could say, yeah, that's a square. Now I can also say that this square is made up of 4 squares, right? There's a square inside of the square and there's 4 of them that make it up, right? But they're the exact same shape and they're pretty much the exact same, right? They look the same, they act the same, they are the same. Now I can also say in that smaller square, there's also another. Now I'm hopefully you're starting to see what I'm going with this. Fractability is simply the model inside of a model inside of a model. Now, why does the market move this way? Because of a couple reasons. Now, 90% of the volume that's traded within the market is from institutions and hedge funds. A lot of the institutions and hedge funds use algorithms to distribute liquidity throughout the marketplace, which causes these patterns to arise. Now, if you also incorporate psychology into it, psychology also plays a role in these patterns that play out in the market. Because at the end of the day, there's still humans that are operating these systems, and there are retail traders that use psychological decision making. Now, when we talk about a model, in this case, like a square, it's pretty easy to understand, but you're probably asking, okay, well, how does that relate to the market and what exactly is the square of the market? Well, the first thing we have to understand is why does the market move? Now, I want to keep this as simple as possible. There's 4 reasons why the markets move. Number 1, hunt liquidity. The market is constantly hunting liquidity within the marketplace, which is highs and lows. Now, the second reason is to rebalance to inefficiencies. These are fair value gaps, as most of you guys know. It's an ICT concept we'll get into in this video. The third one is to rebalance to equilibrium, and the fourth one is to generate liquidity. So that means that any idea that we have in the market, any trade that we take, any way that we visualize the market needs to be based off of these 4 reasons, because this is why the market's moving. So anytime that we're looking to take a trade, we need to have an understanding of where is the market hunting liquidity? Are we rebalancing to an inefficiency? Are we at equilibrium? Are we generating liquidity? All of these things are the main foundation of how I trade and how it all correlates into fractal price action. Now, what you're looking at right now is what we call a market maker model. More specifically, a market maker buy model. Now, what is happening in this model? Well, there's a couple different stages that we have when we are looking at a market maker model. We have the initial accumulation. This is the initial consolidation that normally happens. Now, what is going on in this move? We are generating liquidity. Now, normally what this looks like is stacked highs, right? When we put a lot of highs in the market is going to draw towards those areas. So market has initial consolidation. We move lower. This is what we call sell side of the curve. We then have distribution to the downside to possibly go target an opposing liquidity pool. So let's say some form of sell side liquidity before having manipulation, where we then have one last move lower to take out some form of internal low, then break to the upside. And then we then have distribution to the upside. So this distribution leg is when we are going to hunt buy side liquidity that we had originally generated from the initial consolidation. And this is what we call buy side of the curve. Now, I want you to think of this as the square in our analogy. The square in our analogy is there's a square inside of a square inside of a square, meaning that if there's a market maker model, there must be a market maker model in this model. Now, what does that look like? Now, obviously, this model we're looking at isn't going to 100% look like this in price action. Some of these moves might be more choppy or might be more slow, but this is what it might look like for a fractal model. Imagine on the buy side of the curve, we actually start to accumulate. And what happens internally here is we start to generate buy side liquidity before going lower, sweeping these internal lows. Now, what's going on here? Well, on this move, we're actually then having another manipulation leg to then break structure to then go hunt that liquidity. Now, what is actually happening here? Well, internally, we are generating liquidity to then move price lower, to then take internal sell side liquidity And a lot of the times to the left of us here on this leg, there would be some sort of inefficiency. Now, let me explain everything that's going on here. If the market is hunting liquidity, and that's one of the reasons why the markets move, another one of the reasons is to rebalance to inefficiencies. Let's say that there's an inefficiency below us here. The market generates liquidity first to then move lower, rebalance to that inefficiency, take the sell side that was also generated, then break to the upside, and then have its own buy model internally aligned with the external model. So what I want you to understand here is that this in itself is a buy model. So we have a buy model internally in an existing buy model. So just like going back to the square analogy, it's a square inside of a square. This is a market maker model inside of a market maker model. Now, why is this important? This is when we can gain high quality trades in probability within the market. Trading is nothing but a game of probability, right? We want to have the most confluence and the most conviction within the trades that we're taking. The best way we can do that is say, okay, well, why does the market move? We hunt buy side liquidity, rebounds to inefficiencies, rebounds to equilibrium, generate liquidity. If a market maker model is how the market moves in relationship to the square analogy, then we are looking for the exact same model internally once we already have an idea of what the bigger model is. So once we can identify the bigger square, then we look for the smaller square. Now, the reason why this is gaining conviction and more probability within our trades is because we are looking for the exact same confirmation to get better risk. So for example, if this was the model here and I'm looking to take a trade, I would be waiting for the market to pull back internally to that fair value gap, have a break of structure to the upside, take a long targeting the opposing liquidity pool, which we've already noticed from the bigger time frame buy model, but then I'm waiting for the internal model to give me confluence as to when price wants to go. Because at the end of the day, we could continue to sit here in this range, chop, build price action, generate liquidity, rebalance to the bullish inefficiency that we might have here, and then end up going to the high. So what we're doing is we're saying we're going to identify what the bigger model is, zoom in, find the same model, and then have better risk because of it and more confluence and more conviction as to what the market is going to do based off of fractal models. Let me show you an example of this that happened literally last week. I want you to look at this chart and see what's happening here. So going into Thursday of last week, this is what the 1 hour time frame looked like. Now, what can we identify from this time frame? Well, all of these initial moves from Sunday to Monday to Tuesday, right? The first couple days of the week, we're starting to generate buy side liquidity before having a move lower. A move lower to what? Go take sell side liquidity, right? So the market is doing what we expect it to do. Go take some sort of liquidity. Now, this is what we classify as sell side of the curve, right? We are selling off to go take liquidity before having internal manipulation. When we zoom into the lower time frame, we end up coming all the way lower, putting in a bullish S&T. So that means that ES takes the low and NQ does not. All of the assets that we're going to be looking at are NQ and ES. That's the only thing that I trade because they're correlating assets. So the market comes down, puts in a bullish SMT before breaking structure to the upside on the bigger time frame, right? We have this down close candle in these big highs that the market then breaks through before opening up a bullish fair value gap that again, we rebalance to, respect it to continue higher. So this is where we can recognize buy side of the curve. Now, when we can ask ourselves, okay, well, where is the market drawing to? What's the initial consolidation? All of this is the initial consolidation. This entire price action range from the start of the week is the initial consolidation in this model. So when we can recognize this right here, we can say, I am bullish. I want the market to go to the high that was created on Sunday because that is where the generated liquidity is resting. So now let's zoom in a little bit because when we go into Thursday, what do we want to see? We want to see the exact same model play out. So what can we look at and recognize on this 1 hour? Well, I can recognize that there's a sell side low right here and there's a sell side low right here. And below it is just this big 1 hour fair value gap. So again, we're aligning what we expect the market to do. Go take liquidity, rebounds to inefficiencies. So what the market is doing is it's a distribution of liquidity to liquidity. For the market to go higher, we must go lower first, take liquidity, then go higher. If the market is bearish, we want to go higher first and then go back lower. So going into Thursday, we want to see the market rebalance to go run these lows before having an internal buy model to go take the external liquidity of the buy model, right? So I'm using these terms external and internal, just like the external square and the internal square, which is inside of that square. This is the same model that we want to be looking for that is this on the bigger time frame. So what ends up happening on Thursday? Oh, the market sells off and we take these sell side liquidity levels. Now, once these sell side liquidity levels are taken, we've rebalanced to the inefficiency, we've taken form of internal sell side, and now we want to see the market go higher towards the external high. So what does it look like when we zoom in? Well, let's go to the 1 minute. Now, what can you recognize that we end up doing from 9:30 open to where we are now, which is 10:19? Well, we are generating buy side liquidity. There's a high that's resting here. There's a high that's resting here. There's a high that's resting internally here, right? All of this move to the downside, we are going to not only hunt sell side, but we're also generating buy side to then go later take after sell side is taken. So what do we wait for? We wait for a break of structure. What is my break of structure? Well, this is the high, right? So the market sells off. Once we take sell side liquidity, we then come all the way back up. Notice there's no break though, right? We need to see a high get put in, then a low get taken, then that high gets ran through. So high gets put in, market moves lower, takes that low, and then we see a market move higher out of this. So there's a couple opportunities that we want to trade here, right? This is now where we can identify, I'm expecting to see the buy model. This is sell side of the curve. This is buy side of the curve in the bigger time frame, buy side of the curve and sell side of the curve. So the market breaks through it. What do? We rebalance first to the fair value gap. We go to tap the 1 minute inefficiency. Notice a inefficiency and a fair value gap are the same thing, so don't get confused by that. We come back down, tap it. This is where we want to look to take a long position and target the opposing liquidity pool. Now there's something cool today that I want you to keep paying attention to. What ends up happening here? Let's say that trade didn't get taken. What do you think is going to happen? What do we do here? We end up consolidating on this move. So watch what happens. We end up putting in some lows. We end up putting in some highs. Before the market, what are we doing here? Generating sell side liquidity, generating sell side liquidity, generating sell side liquidity. All of these lows are now getting put in. What do you think is going to happen here before we go higher? The market comes down, takes those lows, puts in another bullish SMT, which means that NQ ends up taking this low and ES does not take this low. So again, this is another model inside of the model inside of the model. Because if we zoom in even further to the 15 second, and again, this is why it shows you that price is fractal. The market comes down to take sell side. What are we doing internally? Generating buy side liquidity, generating buy side liquidity. Market comes lower, takes the internal low, before breaking through the high that was put in. This is where I took my trade on Thursday. So I took this trade. I'll put a screenshot somewhere on the chart so you know that this isn't just hindsight. I took this trade and I put my stop at the low and I targeted all of the opposing buy side liquidity. So this is 3 models. I want you to go and really look at this. This is a buy model inside of a buy model inside of a buy model. This is the epitome of what fractal price action means. It is models inside of models inside of models. And when we can align one model, we can zoom in to find the same thing, look for manipulation, and target whatever the opposing liquidity pool is. So the market ends up rebalancing, taking the lows before going to run all of the buy side liquidity that we had generated, including the external buy side from the initial consolidation on the 1 hour. All of this generated liquidity that started at the high of the first couple of days of the week before selling off to take sell side liquidity before having a break to the upside, rebalancing to the fair value gap, generating sell side liquidity internally, taking that sell side liquidity before forming another buy model. We then have a reversal, internal manipulation, break of structure to the upside on the 1 minute time frame before pulling back to an inefficiency, then continuing in the buy model before pulling back to an inefficiency, taking sell side liquidity, having another break of structure to then continue towards the buy model in the opposing liquidity pool. I'm hoping that this is starting to click for you. So now that you've seen both the drawing example and a real example, this is what I want you to do. First and foremost, I want you to start recognizing market maker models. When you go into the market, notice where the market is generating liquidity, what lows, what highs are being taken, what inefficiencies are holding bullish, where are we going to rebalance to? Ask yourself, the main question is, where do I think the market is going to draw to? What form of liquidity are we going to draw towards? Go backtest and learn to recognize market maker models in your charts. Now, the second thing that you need to understand about this is it's all about being an observer. Your job is to observe price action. When you try to guess and you try to say, okay, well, oh, I think the market's gonna go now or now or now, and you don't be in the mindset of an observer, you're most likely going to miss these trades and you're not going to see them. And the reason why you're not going to see them is because you're trying to force them instead of waiting for the market to show you its hand and show you where the manipulation is and then waiting for the response. I want you to start analysis on a higher time frame. Start at the 4 hour, start at the 1 hour, draw where you think the market's gonna draw to, highs, lows, and then look for areas in which you can expect to see internal manipulation. If you think the market is gonna go higher, look to see where the market could go lower first to then look for manipulation. Is there internal sell side liquidity? Is there lows that are in that move before buy side is gonna get taken? Wait for the market to move lower if you are bullish. Then wait for manipulation and then take your long. If you're bearish, wait for the market to go higher, take some form of buy side liquidity to then break structure to the downside, to then target the opposing liquidity pool. Once you can identify these things, you zoom into the lower time frame and you wait for the same reaction: liquidity, break of structure, and target whatever the bigger time frame is telling you to target. The difference between successful traders and everybody else is not some secret indicator or strategy. It's understanding that you're not trading against some random chaotic market, but the reality is you're playing against institutions with very specific algorithms, plans, and models that have been in front of your face this entire time. And they're not trying to hide it from you. You just haven't been able to see it. They're actually showing you through price action exactly what they're going to do. Your job is to observe their intention, observe how the market is going to move from these ideas. It's all there in the chart if you know how to read it. Go practice identifying these phases. Go practice identifying these models right now. The more you start seeing this, you're never going to be able to look at the market ever again the same way. I used to feel like the market was out to get me and it was chaotic because I didn't understand how institutional order flow worked. I didn't understand how these models actually play out in the market. Once I started basing my trading not off of what I want to see, but what I can recognize and observe, that is when everything changed, because I recognized that this is the truth. This is how the market moves. Once you're able to identify it, your job is not to fight it, but to align with it. Now, I trade this model every single day. Every single day, I'm looking for market maker models. I'm looking for manipulation. I'm asking myself, where do I believe the draw on liquidity is? And I do it all live in our Discord. Every single day, I trade live in front of hundreds of people, showing you guys exactly what I'm looking for, why I'm looking for it, and show you how I'm able to recognize these models in real time. If you're interested in watching me trade live and showing you and helping you understand these models, I'll leave a link in the description to our mentorship where you can join, access my live trading, access a bunch of content curriculum, a professional psychologist in our group as well, and really help you fix whatever problems you're currently having in your trading and get you on track to continue to reap the rewards of being a successful trader. If you guys enjoyed this video, leave a like, subscribe, comment what videos you guys want to see from me next, and I will see you guys in the next video. Peace out.